Hello, hello. Welcome to the Five Talents Podcast. I'm your host, Abel Pacheco. I interview the top commercial real estate investors and industry experts so you can learn from their experiences. So if you're an investor, a high W-2 earner, or real estate or tech sales professional that wants to invest in real estate without having to manage properties or leave your day job, then this podcast is for you. Or if you're already investing in real estate, but you're doing it part-time and you want to become a full-time multifamily or full-time commercial real estate investor, this podcast is for you too. You're going to learn a ton. You will learn from real-life multifamily investors and other professionals in the industry. They're going to share their blueprints for success, and I'm super excited that you're here. So I hope you enjoy the show. All right. Hello, hello. Abel Pacheco here, your host for the Five Talents Podcast. We have just a really another amazing guest. I'm really excited. Rob, thanks for joining us. Mr. Rob Beardsley.
Pleasure to be here.
Hey, Rob, thank you very much, for the really just taking some time out of your busy day, my friend. Since the moment I connected with you, I think through LinkedIn, through a common connection, one or the other, you've been, just very helpful, and appreciate all the information and the networking and potential partnership, all the good stuff, man. So thank you very much, Rob.
Yeah, well, I'm glad we got to connect.
Absolutely. Well, let me, for those that don't know, Rob Beardsley, let me at least give, a few bullet points of your background, and then I'll turn it over to you to introduce yourself. But Rob has really overseen acquisitions and capital markets for Lone Star Capital. They've acquired $100 million of multifamily real estate. So I thought he would be a perfect guest for our show because he's evaluated thousands of opportunities. They really have a nice proprietary underwriting model, and that allowed him also, I guess you don't do anything for 1,000 times and not get really good at it. But he published the #1 book on multifamily underwriting. That's called The Definitive Guide to Underwriting Multifamily Acquisitions. So, in kind of all of his effort, all of his work, he's really good at giving back as well. They've done about 50 articles about underwriting, deal structures, capital markets. He also hosts the Capital Spotlight podcast, the Capital Spotlight podcast, and they're focused on interviewing other institutional investors. So I was really excited when he said yes, that he would come on the show. So again, thank you very much, Rob, for joining. Let me turn it over to you, man. Tell us a little bit about this amazing journey that is your run so far, man. A young run as well, dude. So I'm excited to watch you through your years.
I appreciate that. Yeah. So I know before we hit record, you were digging into my background and you wanted to kind of get to the core and the interesting stuff. And so I think that the takeaway from that was the highlights that, grew up in a real estate family. When I was in diapers, my dad would take me to his construction sites. So it was around real estate, really all growing up. But then as I told you, when I went to college, was studying computer science actually, and kind of really honing in on that analytical passion that I have. But at the end of the day, was focusing on real estate and circled back to real estate and wanted to be more involved in my family's business as well as start my own. And so while in school, I was actually building what is Lone Star Capital today, and was really fortunate to, have the support of my family, have mentors that I was able to lean on and grow from and learn on my own, and then meet a great business partner to start Lone Star with. So yeah, it's been a great journey so far, and we're going to keep growing.
All right. And you're located in New York, correct?
Correct.
So tell me before we get too far into it, Lone Star Capital. The moment I hear that, I'm from the Lone Star State, from Texas. Why Lone Star Capital?
Well, so my business partner, Kent, and I were not very creative guys. And so when we met, we were actually both independently looking at Texas multifamily. So, I was underwriting Houston acquisitions and learning the market, networking there. And so was he, and we were actually bidding on some of the same stuff. So we were trading notes, and that's kind of how we got to know each other, is by looking at the same deals. And, we felt good working together. And so when we decided to team up, we said, well, we're both already focused on Texas. Let's just be Lone Star Capital.
That's awesome, man. That's a great story. And so you guys have been working together for a couple of years and have amassed, a great portfolio, great business so far. So super excited, to hear. So how does $100 million worth of real estate, how does that break down? And give us a little bit of that picture. Like, you don't just acquire $100 million building. So there's a number of transactions, a numbers of deals. Tell us how this all shook out.
Yeah. So I think, and again, we talked about this offline as well. I think a great way to start is by raising capital as part of a syndication and not necessarily being the lead sponsor. So, we did some of that, and we've also been predominantly lead sponsors where we're taking the more traditional GP role and we're seeking out LP equity through the form of a retail syndication, or we've partnered with family offices and private equity firms, and through joint venture structures. And so, we did really only one deal where we took a back seat and kind of learned the process and how to close a deal, how to raise money and participate that way. And then we jumped into a rather large deal, a nearly $20 million deal as our first lead sponsor deal. And it was kind of a crazy story and a really interesting situation because it was a big deal for us. It's a big deal for anyone. And it is still a big deal for us today, which is funny because it was really our first deal.
Yeah.
And I think a part of that speaks to the fact that because we were relatively new, we were kind of, we didn't know any better. We were just naive, and we thought, well, let's just jump into this big deal and let's go find a way to make it happen. And I think you need a little bit of that when you're trying to be entrepreneurial and trying to build something. You need to have, you honestly need to take some risk. And so I think, you might have everything ready to go, all your systems in place, and you've built up these relationships and you're sourcing deals. But at the end of the day, there has to be a leap of faith. And I think we were very fortunate that it worked out. And I think most of the times things do work out. So that leap of faith is, what you need to do it.
Yeah. That was a big first deal for yourself. And obviously, though, the leap of faith, the risk that you took paid off, man. And then you just kept rolling and rolling. So how many, roughly speaking, you don't have to be exact, but how many transactions have you done? How many deals?
7.
Oh, that's awesome. Yeah, that's really awesome. And then, so I'm assuming every single cycle you learn something different than you did, prior to going in.
Yeah, every deal is different. I think that's one of the reasons why I love this type of business so much is the novelty, right? No day is the same, no deal is the same, and they can be different for various reasons. The business plan can be different, the partners can be different, and so you're always learning something new. Especially going back to the partnership thing, when you do deals with, for example, a family office that has been doing this business for 40 years, they know a lot more than you, right? So even if you're the general partner, they're the limited partner, they really have a lot to bring to the table from an experience standpoint. And so I think that's a fantastic way to learn, right? If you're fortunate enough to be able to not only get capital from a partner like that, but then to get advice and guidance, it's just a win-win. You're basically being paid to learn. So we've been fortunate enough to do some deals that way and be able to kind of learn in those environments. And so, yeah, you're absolutely right. Every deal is different, and we've had deals go extremely smoothly. We've had deals go the opposite, and I think unfortunately, really the best way to learn is when things are going tough, when things are tough, and you have an investor last minute pull $1 million, or you have a partner that switches terms on you, kind of how we were talking earlier. So that's where you really learn the most.
Yeah. We've been in 7 active transactions as well. And I can tell you the $1 million pullout has been one. The terms not necessarily changing, but like us forgetting to add something in the purchase sale agreement when when it comes down to timing, you're like, oh my gosh. So you do learn a ton under those rough situations, unfortunately, not necessarily the smooth ones, but yeah, that makes a lot of sense. So, man, you've talked about a number of things, just even in the short moment, which I want to make sure we highlight, right? So you found your partner for Lone Star Capital. You guys are in New York. You guys are looking for deals outside of the East Coast, and you found yourself butting up against some of the same deals. So kind of rather than compete, or you were sharing notes, you were partnering. So you understood early on, like, man, it's about partnership and kind of working together. So that's one of those things. Another one that you mentioned was, thousands of transactions under, and um, maybe we can take those two, first. Like, how did that partnership start? How did you meet? How did you network to find? How did you find out you're working the same deals? How does that actually happen there?
So my business partner and I, we actually met at a conference, which I think is very rare. Some people
Yeah.
do indeed go to conferences to meet their partners. We weren't those types of people, but we were very fortunate to have that click and have that happen.
Yeah.
And so, that really isn't anything to it. I think we just got really lucky. And
Yeah.
so can't really say much more than that. But on the
I'll
transaction side, yeah, go ahead.
Before you hit the transaction side, I will add though, I'm a big subscriber to a big fan and subscriber to the mindset of, like, luck is where preparation and opportunity meet. So if you're prepared and you happen to take enough of those actions, like go to the conference in the first place, the seekers are the ones who find. If you don't go to the networking event, if you don't go to the conference, if you don't go to the webinar right now, if you don't go to those things or make a phone call or try to introduce yourself, like, those things never happen, And so you were the seeker, you were the action taker, you were the person that did that, and you were prepared. Your opportunity, came, or that's where your luck came from, was, preparation and opportunity met, man. So it sounds like for both of you guys. So that's good stuff. I just wanted to
Yeah,
highlight that.
you're so right, because being at the conference, you can say, oh, well, have you heard of X, Y, and Z deal? Oh, actually, I have. Here it is. It's underwritten, and here are my notes, and you're ready to go. So absolutely, being prepared is crucial. And I'm naturally an introvert, and so even doing a podcast or going to a conference, pre-COVID, I would, sometimes want to say, maybe I don't want to do this. But every time I have that feeling of hesitation, I know that I'm about to do something that's actually very worthwhile, and you might end up with something really valuable from it.
Yeah, that's awesome. I did get connected to you from somebody on LinkedIn. However, I saw you, or had reached out to you first because of Joe Fairless podcast. So Joe Fairless, you looking at underwriting, and I was like, you know what, I'm gonna get this. He's got a free analyzer, which we'll talk about, and or I don't know if it was free, but it was like an analyzer. Let's sign up. Let's get on it. Underwrite some more deals. And then it was like the next week that somebody said, "Have you met Rob?" And I go, "Dude, I just signed up for your book." And anyway, so that's a good thing. You're getting out there and pushing yourself to do something. When you said you're naturally introverted, that's pretty awesome. Um, how, before we get to the thousands of transactions, how did you, like, do this? So for all the introverted people that are listening, how do you push yourself to get out of that comfort zone to say, yeah, let's do another cycle here?
It's really out of necessity, right? Because especially when you're talking about starting a business, you have to wear so many hats, and you might have started the business because you really like to underwrite, for example. But then guess what? When you're running the business all yourself, pretty much, there's much more that you have to do than just the technical or whatever it is that the kernel that you actually are good at or want to be focusing on. And so that's what I found myself doing, is as we were growing our business, out of necessity, I realized that, hey, I can't just sit in a dark room and underwrite all day, because we're never going to go anywhere doing that. And so we had to actually get our message out there, grow our network, so that we could find like-minded investors, find like-minded partners, and grow the business that way. And so that was, it really is do or die. And so that's how the introvert gets out there. I think it's really, anyone can do it. It's just, how bad do you want it?
Yeah, that's awesome. Thanks for sharing, man. And now, so thousands of transactions. Like, um, the first time I looked at a P&L and a pro forma, and try to look at return rates, and how do I split an LP and a GP split? And I'm like, what in the world? I look at this huge calculator, and this is, when I say calculator, an Excel with like many multiple different tabs, and 200 line items on the first sheet. Anyways, how in the world do you actually kind of began this journey of thousands of transactions to now, one of an expert and one of the best, underwriting books that there is available today, man. So talk to us about this journey.
Yeah. And so, I have to admit that I am somewhat naturally good at it. And so it did come naturally to me. But with that being said, it was really a function of iteration. The first one isn't perfect, and then the next one's a little better. And it just kept snowballing from there. And I think there are two things that really helped accelerate that learning curve for me, which were, number one, going out there and building my own model, right? Being really intellectually curious and wanting to get my hands on everyone else's model and see how everyone else is doing it, and then take the best pieces of those, make my own, and then go out and get feedback on how to improve it. I mean, so many times I've put it out there for people to tear down, and then I rebuild it and just keep iterating it. So that iterative process is super helpful. And then along the same lines, when you actually underwrite a deal and you're going to bring it to a partner or an investor or a lender and let them take a crack at it and scrutinize it, right? That's very, very valuable experience, to get their take on it. And if you actually listen and take notes and implement going forward their suggestions, then again, that's just going to grow and you'll refine the process. So through both the process of iterating on the model itself and then iterating on just deal after deal underwriting, it just becomes very refined and then also like second nature.
Yeah. Yeah. You've just described an amazing process, not only for, your underwriting journey, but just about every new venture or new opportunity that we have to go under, right? You just got to do it. Number one. And then the iteration part of it, you're open to letting it out to show others. And then you're open to feedback to change it. And then, every cycle you learn more and more. And then you took feedback from great sounds like other investors, both GP and LP, and that's awesome. That's great. So we have on the show, I would say, a good mix. We have some people that are limited partner passive investors that are probably trying to learn a little bit more about the world. And then we probably have a few first, second, third time general partners that are trying to get in, get their first or second deal done, or maybe learn a little bit even more. So let's talk about the underwriting side, right? So there's mechanics and metrics that go into any new deal, and it's kind of like at the heart of every investment. You got to know it's a good deal before we even put in an offer. If it's not at their asking price, then you got to know which price that it will become a good offer, and you got to know how to to kind of to evaluate the deal before you kind of jump in. So why don't you walk us through, like, at the highest level, what is the underwriting, what is it, and then talk about some of those components, or that you've learned through all the thousands of cycles that our listeners would benefit from.
Sure. So starting off with the high level question that you mentioned, which is, let's take a step back and answer what is underwriting. For those that aren't familiar, when we're talking about underwriting, we're really just talking about analyzing the numbers associated with the deal, right? The financials, meaning the revenue, expenses, and then we layer in debt assumptions, and then we have also growth assumptions. So how do those revenue and expenses trend over time? And then there's a reversion calculation, which just means sale, right? Eventually, it might be 3 years, 5 years, 10 years, you have to sell the property, and that's where your terminal valuation comes from. And then finally, that's your stream of cash flows. And then you have a partnership structure where there's a GP and an LP involved, and there's a flow of the or split of the profits. And so that's really underwriting. It goes from the very start where you have just gross potential rents, and then it flows through all of those calculations to basically what does an investor get at the end of the day, after expenses, after debt, after fees. So it's a very holistic process. And to me, it was always obvious that it was the most important part of any deal. It's the numbers, right? You're not gonna, I mean, who cares if the building looks pretty, or if it's in a good location, or if if it has a certain amenities. It's all about the numbers. And so you need to be able to distill both the quantitative and, more difficult, the qualitative assumptions about the deal, and distill those into actually financial underwriting. And so when you have something like, oh, the property's in a great location, okay, great, how do we actually correlate that into the numbers? Because we're not just buying because rent growth has historically been high and jobs are moving here, and someone just relocated their headquarters, right? Because that might be great, but like you said, if we're paying the wrong price, it doesn't matter. So that's high level what we're trying to accomplish when we're underwriting.
All right, good. Yeah, great stuff. Because, I think Rob mentioned it, at the core of every deal, at the center, at the heart, whichever you want to call it. It's, we're not doing all this work for nothing. We're trying to make the best possible return. I think the correlation part that you mentioned, that's another one where if I'm just hardcore looking at numbers, but I can't factor in, this is actually a great market, sub-market, great school system, great, like, you got to be able to put those things in there. And that comes with a little bit of art and science, right?
Yeah, it's very much so an art, because like you mentioned, and we were just saying about the qualitative, you can't just you know take like a good school district and just plug that into the underwriting, because what does that mean, right?
Yeah.
So yeah, it is an art of saying, well, should rent growth be a little bit higher because we think we're in a slightly better area, or we're looking at the supply versus demand fundamentals for the market and things like that. And so all that needs to be taken into account. But I feel, and this will resonate potentially with your, limited partner audience, about underwriting in general is potentially a foreign concept to them, but it shouldn't be. Really, as a limited partner, it's almost, underwriting is more important, because that's really one of your few tools in your toolkit. Because as an LP or a passive investor, all of the work you do in a deal is upfront, up to closing, up to you committing capital. Thereafter, that's it. You just collect checks. So what that means is you should be actually hyper focused on everything that you can do pre-committing capital, which would include, whatever level of due diligence you feel is necessary for your process. But certainly, a 30-minute underwriting should probably fit in there, right? We're not asking you to fly out to the property and walk every single unit. So I think that to most investors on the passive side, they feel that underwriting is an unreachable thing that they'll leave up to the experts. But, I disagree with that. And, in my book, I try to go a long way to really break it down to the basics, yet be robust enough where anyone who can pick that book up and read it will be able to actually underwrite a deal confidently and be able to make real financial decisions based on that underwriting, with some practice.
Yeah. Yeah. That's good, man. Everything you mentioned. I invested passively as well. I invested in about 400-ish doors. So a couple of times myself, and then my wife got in, on a deal herself as well. And so every time we looked at it, we were looking at the monthly reports. Really, we jumped in without looking at any underwriting, right? It was more like a trust thing. I knew somebody had a good track record. I've known them personally. We jumped in. But every time I looked at the monthly or quarterly reports from our investment, I'd see the P&L. I'd see the rent roll. And we started looking at that like, there's all these numbers. I have no idea what the heck this means. Like, I got to dig in, right, for myself. And the more cycles, the more, the time that I spent in this area, even though it's not my financial gift, on the front end with an Excel, it got easier, it got better. And I was like, oh, this is what we're doing. And now, as an active participant, that was really the foundation, or the underlying, I guess, just basis on which we can say, okay, I'm going to go be an active partner, and I know what the heck I'm looking for. I still want to partner with people like you, frankly, that can look at everything, but I at least need to be able to give it a first pass and say, hey, are we in the range? Yes. Okay, cool. So this is very helpful. And I think those limited partner passive cycles, if you can invest and learn how to do it, later, right now, it'll make you a better limited partner. But two, if you ever want to be an active member, like, dude, that's That's it. This is what you need to do to go be an active partner, at least finding some deals, right? Well, good. Hello, hello. You're listening to the Five Talents Podcast. I'm your host, Abel Pacheco. If you're enjoying this podcast, then I know you're serious about achieving financial freedom. Are you ready to create your own path through multifamily investing for yourself and your family? Then I know you're going to appreciate our Investor's Guide to Multifamily Investing. It's titled Tackling Commercial Real Estate the Easy Way. We use this guide to invest ourselves in $93 million worth of real estate. So we're going to show you the basic mechanics of multifamily syndications and how to evaluate your next passive investment opportunity. So the best part, if you subscribe to our podcast now, leave us a review and a rating. I'm going to give you a free copy of our ebook. So please take a moment to do that now. Once you've done that, go to 5tcre.com/ebook, 5tcre.com/ebook. Make sure to let us know you left a review and we're going to send you a free copy. So thank you so much for subscribing to the Five Talents Podcast. We really appreciate it. Well, so Rob, tell us about the structure of your book. Like, it's not it's not on a computer with an Excel in front of me, and you can't really walk it through. But you try to do a great job of breaking everything down. So, how does your book laid out? For somebody that's thinking about, man, I'm going to go pick this thing up, and what do you cover, like A to Z, and maybe just break that down a little bit.
Yeah. So really, the heart of the book is walking through the underwriting process as we do it. Everyone's got their unique way, but walking through our process literally step by step. And so when I say step by step, in the book, I take screenshots of our Excel model, the inputs, and then I'll just pasted a chunk of the inputs, and then every single line in that screenshot, I address, okay, this here, you want to, this is what this means, and this is the typical range of inputs for this, and here's how it affects the resulting numbers and things like that. So it was really easy to write, but it's probably a little boring to read, I'll admit, because all I did is I used my inputs tab as a table of contents, and starting from the top of, input the purchase price, and then we're going from there as far as the rents and the vacancy and collections and things like that. So that's the meat, is really getting you. So, and like you mentioned before, my model's available for free download, whether you buy the book or not. So if you just want the model to tinker around with, you're free to jump to our website and get it and experience it for yourself. And then if you want to actually get more of a handheld experience while going through the model, then the book will be an excellent complement, as well as a resource that you can reference back to anytime that you're looking at something and are unsure about potential input. So that's, like I said, the heart of the book. And then there's more things that wrap around that core underwriting process, which are understanding partnership structures a bit, and how to actually incorporate that into your underwriting, whether you're doing a preferred return and having a promote and certain fees, breaking things down that way.
That's great description of the process. First book I read, I read Rich Dad Poor Dad, purple and yellow book. Most people have. I'm like, okay, if you're on our podcast, like 80 or 90% of the people have, right? But the next one that I read was The ABCs of Real Estate Investing by Ken McElroy. It's another purple and yellow trusted advisor book. And it was laid out in the way you're describing. And that was the first time that I was, kind of eyes open to underwriting. And I think this is like, I don't know, 08 or 09 for me, right? And so I'm just kind of like looking through this. And then I saw Rob's book and I go, man, I'm going to go get it. Started cracking it open. I go, oh, this, it feels like the same kind of exercise, except start to finish all the way through. So I thought it was good, man. So a lot of success, and wish you a lot of success on that book and release it. I think you're going to help a lot of people. So where can we get the book? How do we go download it? Might as well just say it right now since we're on it.
Absolutely. I mean, the book's available on Amazon. Feel free to type out the book name, The Definitive Guide to Underwriting Multifamily Acquisitions, or if you just search multifamily underwriting, it'll be one of the first few to pop up.
Right on. And so thanks, Rob. So this is kind of transitioning a little bit. not so much to the book and underwriting. Well, actually, yes. I apologize. One more spot before we go to the next, which is what are some of the biggest items that you think people miss in this underwriting? So, well, number one, you're telling us how to do it. It'll be laid out. It'll be described. We know what it is. The underwriting. What are some of the finer details that just we would have never caught had I not looked at 1,000 models like you?
Yeah, so there's kind of the classic ones that most people catch on to once they underwrite a few deals and have seen a few deals pitched to them, right? And calling those out would be rent growth and the exit cap rate. Those are the kind of the two big ones where you can quickly and easily make a deal look really good based on small tweaks to those numbers. And then so that's kind of the basic stuff. I don't want to give you super basic stuff. More more nuanced stuff goes into how the model is actually built, and I think that's a really interesting conversation because most models are generally the same, but then there's a few key ways that models differ, and that's on the value add multifamily side. Almost all models are different in the way that they project stabilization, and this is a very underrated topic, and nobody really we get grilled on this from the institutional investors that we work with.
They
But,
hit it.
yeah, they know. But on
Yeah.
the more passive investor side, they kind of gloss over the stabilization period, if you call it, or the period of time that you expect to implement your business plan.
You've renovated half of your units. When do those start increasing rents? Is that day one in your model? Is that 6 months in, or is that year two? Right? And can you really pull off 50 unit renovations in the first year? Is that what you're talking about?
Exactly. And then on top of that, you're renovating 100 units in a year and maintaining 95% occupancy. Right? It's not mathematically possible. So there's
Yeah.
certain situations like that. So understanding how the model is actually built to forecast that out, because there is no right or wrong there, but just understanding it is important. And then making sure that it makes sense, right? Kind of backing out the numbers and saying, rationalizing and saying, okay, well, if we've got 100 units and we want to maintain 90% occupancy during the renovation period, that's 10 vacant units at any given time. How many of those can we turn per month, type of thing. And so making sure those numbers make sense. So that's more of an under the radar thing to pay attention to. And I actually recently wrote kind of a fun tongue-in-cheek article called 6 Ways to Juice Your Underwriting, which was, I was kind of highlighting all the ways that you can really make your underwriting way too aggressive. But,
Or
a lot of
mess
people,
up or juice your return. Well, whichever one you want to look at it, right?
right. Yeah, exactly. So, so that's definitely some interesting topics.
What were the 6?
Oh, I can't
Or
remember.
if you remember how bad, what was the article? Where's it at? We'll go check it out.
Yeah, it's on the LoneStarCapGroup.com website.
Okay, cool.
We have an insights tab. Highly recommend. Under the insights, we've got articles, newsletter, the Capital Spotlight podcast, the YouTube channel, the book, and different things like that. So, it's definitely recommended.
Well, that's good, man. Because let's break this down just a little bit for passive or limited partners or general partners that are new starting out. Right, rent growth is kind of simple. What percentage of increase do we want the rent to grow? Are we bumping it up at 1%, conservative, 2%, a little less, 3 or 4% today? Maybe not the most conservative. You're very aggressive in that rent bumps. And then the exit cap. This is a big one, even though it is like one that a lot of people know. It could be unknown how large of an impact a few basis points makes at the end run. If I'm exiting at 10 basis points a year or 20 basis points a year, however long I've held it, right? Because maybe break this down a little bit too. Like when you say reversion cap and exit, I buy it up 5.5 Texas real estate, and I model at a 6 or 6.5. What does that do to the underwriting, and what does this mean?
Yeah, so the whole purpose of an exit cap, or like you said, reversion cap, is a way to derive your sale valuation, right? And so the way that typically models do that is via taking some form of terminal income, right? So let's just take the most standard example of a 5-year business plan. You would take your year 5 NOI, which would be your last year NOI, and you would apply a cap rate to it. So essentially divide it by, let's say, 6%, and that would create your value that you would sell at. And that makes sense because real estate investors in the commercial space are income-driven investors. And what you're basically saying is that in 5 years' time, someone's going to buy this property for me at a 6% income rate. So when they buy the property at an unlevered basis, they'll be able to derive 6% on their money. But then with leverage, they'll be able to obviously generate a higher return. But that's how people, look at the income potential of a deal. And what you alluded to is the correlation between your going in cap rate and your exit cap rate. And, there's absolute truth there, but I think that's also somewhat of a myth that, I like to explain the additional nuance, because what the reality of going in cap rates are that they vary substantially based on the deal's profile. To give you a really extreme example, let's say I'm buying a property in a pretty good area. So the cap rate is, like you said, 5.5. But here's the catch. I'm buying a property that's half vacant, right?
Mm-hmm.
That cap rate might be only a 2 cap. It might be a 1 cap because if it's half vacant,
Mm-hmm.
right?
Mm-hmm.
So just because I buy a 2 cap doesn't mean that I get to be a conservative investor when I raise the exit cap rate to 3%, right? Because 3% obviously is not market, it's not realistic. So the appropriate way to look at your exit cap rate is to take the approach of understanding what type of product am I actually selling in 5 years' time? Am I selling a stabilized asset? Because stabilized asset trade at higher cap rates. Or am I selling a value add deal, right? You might actually buy a property, for example, that's completely untouched, lucky you. You're buying a property that was owned for 30 years and now it's yours. You're going to, let's say, renovate 20% of the units, prove the upside. There's now $200 rents proven in your renovations. And now you can go sell that property at a compressed cap rate on exit because there's a value add potential, right? Investors are happy to pay you a 5 or 4.5 cap if they know that they can go and raise rents $200 because they'll be then operating post stabilization at a 6.5 or even 7 cap rate. So that's the nuance. You can't just look at your going in versus your going out. It's a little more of a nuanced thought process.
That's so awesome, Rob. So thank you very much, because you're opening my eyes to different paradigm, even like right now, because I'm modeling 10 20 basis points if I want to be conservative. And I say every year I hold it. If I bought it at a 5.5, then 10 basis points or maybe even 20 is what I say is conservative. So if I held for 5 years and it goes to 6.5 cap. However, like you just mentioned, if I were to buy something that is in someone's hand for 20 years and they didn't do any renovations and that market rent is super low, and I put some new, floor, paint, carpet, fixture, well, not carpet, but vinyl plank flooring, paint, fixtures, lighting, whatever, and my rents go up $200 a month, and I did it on 20% of them. Now I can say, dude, this is a sweet value add. You should buy this. And somebody will pay way higher price or a lower cap rate. That makes a lot of sense, man. Thank you very much. That's good insight.
And
Wow.
then just another interesting thought there too is, so kind of your first thing you learn is it's a sin if your exit cap rate is lower than your going in cap rate, right? I mean, that's
right.
Right.
I never want to model. I don't want to model that a lower cap rate. I just don't do it. I never
exactly
touch it.
Right, and that'll definitely keep you out of trouble. But there are certain circumstances where that actually makes sense. For again, to use another dramatic example,
Please.
Let's say you were assuming someone's debt, right? Because sometimes properties trade subject to the existing loan, right?
Mm-hmm.
And for whatever reason, because of the loan covenants, you have to assume it can't be paid off. And so let's say the existing loan is at a 6% interest rate, right? Mm-hmm. Well, today, as we're recording, rates are around 3%. Yeah. So in order for me to be compelled to assume debt at 6%, I'm going to need the cap rate that I'm buying at to be maybe 7, right? So, but in reality, the market cap rate is probably 5, 5.5, maybe 6. So I would actually be not wrong to buy at a 7 and then let's say project to sell at a 6, just given the bad debt that you're assuming. So again, rules are good rules, but they also are made to be broken.
Well, man, there's a couple different mindsets when you've underwritten thousands of them. You see some different looks. Well, that's awesome, man. That's great to know. So, and then the couple other things you mentioned were the in the model, the way the model's built. And let me just make sure we have enough time for this in the conversation, which I think we do. It's, if I'm renovating, if my plan is to renovate 100% of the units and sell it at a lower cap rate later, then at what rate can I do all of these interior units? And if there's 100 of them, then that means I'm going to do 20 a year, for example. Or let's say I'm bullish, I'm going to do 100 in 2 years. That means 50 year one, 50 year two. And if it's occupied at 95%, like you said, it's really kind of unreasonable of an assumption for me to say I'm actually going to be able to logically, physically do that and move people out of their units and renovate 10 and get them turned over. And, it's a lot of mess and a lot of hassle. And people, you're going to mess up your occupancy, or you're not going to be able to do the amount of renovations. So does your model reflect that? Right. And
yeah, your levers are occupancy, right? Because if it is your business plan to, let's say, turn the whole property over,
yeah,
possible, but you're going to have to, incur a lot of vacancy.
Yeah. Yeah. And your family offices and institutions, they are all over this.
Right. They're comfortable with risk and they're comfortable
Yeah.
with bridge loans and, turnaround executions, but obviously it has to be underwritten accurately.
Okay, well, that's awesome. Well, on the last topic, thank you very much, Rob. This has been an amazing conversation so far, and so I really appreciate it. I feel like we're just kind of scratching the surface a little bit, but maybe have you in another show later. Another thing I wanted to talk about was you guys doing preferred equity. So, like, preferred equity is a big question mark. I think for a lot of general partners and a lot of people that if you're not really in the area of like analyzing capital structures, your capital stacks, mezz debt, preferred debt, all the different types of, we're just thinking about, look, here's my debt and equity. And those are the two things that make up a capital stack. But why don't you illuminate a little bit, like what is preferred equity, and then maybe what you guys are doing with it over there.
Sure. Yeah. So like you said, when you're kind of just learning capital structure, you think there's just debt and there's just equity. And then the more advanced structures start coming up. And it's interesting because in a way, the GP-LP structure that many people indeed are familiar with, right? It's not foreign to them. They understand the preferred return and how that works and how they get paid first and then the sponsor gets their promote, right? That's a more nuanced deal structure where you have certain equity subordinate to other equity, but in this case it's the sponsor's performance compensation that's subordinate to a certain return for the investor. So when you start getting into the middle of the capital stack, like you mentioned, you've got mezz, you've got pref. These are financing vehicles or capital structures that straddle the line between debt and equity, and they can kind of be, they're in the middle, but they can have sometimes characteristics that are more like debt or more like equity. And this is where you can, come up with more interesting deal structures that, we can get into more, but really just to define, preferred equity, for example, the best, I would say, you are making an equity investment, but you have certain rights and remedies that are similar to a debt investment. And you also have a fixed rate of return that is similar to a debt investment. So you have, bounded upside. You're not going to participate in the profits.
Got it. So I would say I'm listening and I kind of know what they are, but even then my eyes go still like, what does that mean, Rob? Tell me what that means a little bit further. So there is the middle of the stack. Most people don't know. There are some equity sources that get into, like, they're kind of loan, they're kind of debt, they're kind of equity. And the difference is equity, that is, you own the property and you're in it for some upside. Debt is, hey man, I technically you got a lien on the property. It's some kind of senior debt. You can take the property back, but you're not an equity owner. you're in it for an interest percentage of return and that kind of thing. So preferred equity is kind of like it straddles those two. Maybe one more simpler sentence for a simpleton like myself.
So basically, the way that we approach preferred equity is we are sitting in the equity position of the deal, right? We're not a lender. We don't have a lien or anything like that. And
Yep.
we are also subordinate to the senior lender, just as
Mm-hmm.
the rest of the equity is. But the difference is preferred equity is senior to the common equity in the deal. So preferred equity is first to get paid after the senior lender, and it is paid a predetermined return. It's not just, well, if their cash flow is there, we'll get it to you and we'll see how much there is. No, it's a set amount,
Mm-hmm.
and right, so it's predetermined. And then if it's not paid, there are certain rights and remedies that range from, you know, to something like default interest, to management takeover, to
Mm-hmm.
forcing a sale. And so, and then on the mezz side, you can actually go through a foreclosure process to take over the equity position. So, you know, mezz and debt are very similar, but that's one of the differences. So that's kind of the middle. Hopefully that makes sense.
It helps. It definitely helps a little bit. And so if I'm a as a preferred equity source, I'm under the senior debt, which is under the senior loan, subordinate, but I actually get paid, or I have a little less risk than my limited partner or the equity sources, the general partners, because if it had to be liquidated tomorrow, senior debt gets paid first, and anything over preferred equity would get paid next, and then the general partner, or limited partner, and then general partner. So it's kind of right in between. Okay, that makes sense. So help us describe this a little bit, like what you guys are doing with preferred equity. You are now a capital source. So you were on the buying side, where we probably still are, buying, raising equity, and going to buy new deals. And then also, I'm a general partner. If I'm looking to go acquire something, I may look to you guys to help me raise the capital. Is that right?
That's exactly right. So we're remaining active on both our principal and our preferred equity side of our businesses, and they're very complementary, since, you know, we're getting market information through both sides, right? We're seeing deal flow on both sides of the business. And like you said, on the preferred equity side, now we're a capital provider. And it's a great experience and position for us to be in, because we, on the principal side, when we're acquiring properties, right, we're a user of capital. And so we
Mm-hmm.
understand what it means to be a GP. We understand the needs and how we like things to be structured and how we want things. So when we're actually providing capital, we can better tailor that, you know, to those needs, and we understand those needs. And so we, you know, try to be a good partner to work with, and, you know, flexible, and so that it makes sense. So I think it's helpful to see both sides.
Yeah, that's cool. And as a preferred equity provider, I'm assuming that I'm assumed a little less risk. So I'm borrowing at a lower interest rate, lower risk for you guys, borrowing a little bit, lower interest rate, higher than the senior debt source, but lower than a limited partner if I had to raise, $3 million for my next acquisition. Is that right?
Yeah, that's exactly right. And that's what we're looking for. And, you know, the two primary reasons why someone would seek out preferred equity
Mm-hmm.
would be, number one would be a simple factor of, hey, I'm raising 3 million bucks, and if I can get 1.5 from you all in one check, that's great, right? So it's
Yeah.
just the access to capital is number one. Number two would be actually for financial leverage purposes, where if you think about, if you find a great deal and you think it's a home run, it's projecting to be a 25% return. Well, do you want to bring in limited partners that are going to ride that upside with you, or would you want to bring in a preferred equity investor like ourselves, who's going to earn their fixed rate of return, and you get 100% of the remaining upside?
Yeah, I'm sorry for the limited partner passive investors that are listening to this, but I would much rather take Rob's preferred equity dollar. Just when you think about it, though, like as a general partner, if you're listening in, this is if I'm promising to pay, or not promise, but if I provide a return projection to our deals for a limited partner at 16%, 15%, that's like, it's pretty much like a credit card. I am borrowing a couple $1,000,000 from limited partner passive investors at credit card interest rate, and I'm promising to pay that back at credit card interest rate. So if there's a way to get it cheaper debt now, maybe the preferred equity comes in with $1.5 million. So my $1.5 million limited partner passive investors, I still need them. I just don't need as many of them. And they get in on a good deal. Preferred equity comes in. It makes our job a little bit easier. And then we can go buy potential, like Rob said, more leverage, right? And we can go buy a second deal a little bit more quickly than we would have been able to buy only one. So,
right. You can grow faster, and then, you and your investors do benefit from that financial leverage, like I mentioned. So if you do get positive leverage, right, you might have taken the deal that you thought was a home run and it's an 18, 19, 20. Well, with the preferred equity layered in, now all of a sudden it's a 23 or a 25. And so that can be, of course you're subordinating yourself, but the benefit the upside of that is preferred equity is most of the time structured as more of a softer form of leverage, where it's not do or die. You're not going to be foreclosed on if one single thing goes wrong. So, you do get the benefits of leverage, but it doesn't cut maybe quite as deep when you're talking about the downsides.
Yeah, this is awesome. Well, Rob, I apologize. I'm having such a great conversation. I don't even look at my freaking time yet. We're at time. Let me let you go to your next interview or meeting. Where can our guest, our network, reach out to you? Where do we get in contact with you if I'm either looking for you as a preferred equity source or want to invest with you on future deals? What's the best place for them to reach out to?
Yeah, I appreciate that. So the best place to learn more about us and get in touch is to go to lonestarcapgroup.com. You can, fill out the new investor form so we can connect and see if we're a good fit. You can also, like I mentioned earlier, you can download our underwriting model that we use every day for free. Go ahead and check that out. And I look forward to hearing from you.
Man, so awesome. Thank you very much. And Rob, I think I'm going to have to get you, if you're willing to commit to we do a weekly Wednesday meetup. We're trying to do it every Wednesday at 12 p.m. Central Standard Time. So we'll have to come get you as a guest speaker and meet some other general partners and other people in the business as well. And is there anything else we didn't talk about that you want to, in the last couple of minutes, just if you have time? I don't know if you do. Anything we didn't touch on?
I've been throwing a lot at everybody, so I appreciate for everyone sticking around this long. Another fun piece, especially related to preferred equity, is the Preferred Equity Manifesto ebook that, because it's such a complex thing that not as many people understand, I really felt that I needed to write something that would break it down and really outline how it works, the benefits, et cetera. And so you can go ahead and also get that ebook for free on our website as well. Just head over to the insights section.
Nice. There's another good one we're going to have to pick up. Well, Rob, thank you so much for your time. I sincerely appreciate it. Again, my name is Abel Pacheco. I'm your host for the 5 Talents podcast. If you guys appreciated something, you got some value from today, reach out to Rob. He'd love to talk to you, and go to our podcast. Give us a rating and a written review as well. So again, Rob, thank you so much. Let me let you bounce, and thank you very much for your time, man.
Thanks.
All right. Bye-bye. Thank you for listening to this episode of the 5 Talents podcast with your host, myself, Abel Pacheco. Each week, we're going to bring you interviews from industry experts and commercial real estate investors who followed their dreams and achieved massive success. Before you leave, let me ask you a few questions. Did you enjoy this episode? Did you learn something valuable? Was your mind stretched to what's possible and what you can achieve? Do you want other experts just like the one you heard today? If you answered yes to any or all of those questions, then please take a moment to subscribe to the 5 Talents podcast, give us a 5-star rating, and most importantly, leave us a written review. Tell us what you liked, tell us your favorite guest, give us any feedback. I'm excited to learn and improve so you can get a more valuable show. So thank you again for subscribing to the 5 Talents podcast.